Welcome to the Score podcast.
Because of predatory lending, $9 billion is extracted from low-income communities of color annually through exploitative interest rates of up to 600%. That's billion with a capital B. We've probably all had a situation where we've come up a little short and we've had to borrow money from friends or family to avoid using predatory lenders. But what if I was to tell you that that transaction might actually help you start to build your credit? I'm Jeff Richardson, host of the Score podcast. People can actually demonstrate their creditworthiness through peer-to-peer loan repayments. However, these repayments are not recognized by mainstream finance, at least not yet. But one up-and-coming fintech is aiming to change that. Today, I'm speaking with David Henderson, founder and CEO of Giving Credit, which is a social credit network that recognizes and capitalizes community finance. Giving Credit helps map social credit networks, revealing how much you can borrow from friends and family and tracking it. Giving Credit was founded by David, and it was actually incubated at the Princeton University, where he was a Sugarman practitioner in residence. Like many of us, David has been invested in his community, and there have been times when David has been the bank. Banco David is what his Panamanian mother would call him, as he made informal loans to friends, family, neighbors, and coworkers. David, welcome to the Score podcast.
Wonderful to be here.
So, David, we've gotten to know each other a little bit over the years, and you have a really interesting background, and we'll get into that. But the first question I want to ask is kind of a broad but challenging question, I think. But we talk a lot about what is financial inclusion here on this podcast. But what are the root causes of financial exclusion?
The root cause is this country's history of race-based financial exclusion. There's this incredible book, The Color of Money, Black Banks and Racial Wealth Gap, written by Mirza Baradaran. And in that, she goes through the history of the ways that particularly people who are Black have been excluded from the financial system. So really starting in 1865, you have the establishment of the Freedmen's Bank, which was meant for emancipated persons to put their savings and build wealth. Well, shortly after its establishment, fraud wiped out that bank and wiped out people's savings. And so that created a lot of understandable mistrust in the Black community towards financial systems. Then as others started to create their own Black banks, those Black banks were cut off from mainstream finance, from other white-owned banks that really owned the wealth. And so as you have sort of this exclusion on the banking side around the same time in the 1800s, the history of actuarial sciences or life insurance policies also starting in around the 1800s. There's an incredible book, Calculating Race, Racial Discrimination and Risk Assessment, that shows that race was explicitly put in these sort of predictive models around life insurance. So then as you transfer into the 1900s, you have redlining. So you're now building wealth in mortgage markets for people who are white, people who are Black, locked out of that. So then increasing racial wealth gaps. Then in the 1980s, banks start to increase deposit limits, increase fees, which then just starts locking out people who are Black and other people of color from mainstream finance altogether.
Thank you for that answer. And where we find ourselves today is at a point where many consumers in America are doing really, really well, and many continue to struggle. And of course, that is kind of weighted within the minority community. And what we're seeing is those gaps, whether it's the racial income gap or the racial homeownership gap, we're not chipping away at those. It's actually going in the opposite direction. Those gaps are getting wider. So how is Giving Credit aiming to change that paradigm?
Yeah, so there's a couple of factors at play here. But first, I would say that through the 1970s, what we saw was as productivity increased, wages would increase as well. And then coming around late 90s into 2000s, we've seen that invert. So productivity keeps increasing, but wages are now decreasing. And so I provide that framing to say that there's not an issue where people who have more money are necessarily working harder. There's really good evidence that people of all income groups, racial groups are working a lot. The issue is the different ways in which the deck is stacked. And so one of those is wage inequality. But another part of that really is just wealth inequality. And when we think about wealth inequality, there's not just sort of what I have access to through my own wealth, but also who can I borrow from? And so this is sort of core to what we're doing at Giving Credit. And I should also say that I'm concurrently a visiting fellow at the Boston Fed Reserve Bank, where I'm authoring a paper on sort of peer-to-peer lending and sort of calculating US household peer debt into thinking about household sort of debt profiles. And so one of the things that we unearth in that paper is that US consumers hold about $200 billion in peer debt. So to contextualize that, credit card debt's approaching $1 trillion. So a fifth of that value, literally people just turning to friends and family and borrowing from one another. And so if you are somebody who has access to other people who are wealthy, you have more access to this type of informal credit, which tends to be zero interest or borrowing from friends and family, versus if you're a person of color, you're more likely to have materially poorer networks. In fact, there was a study that showed that 10% of the racial wealth gap is attributable to the fact that people who are Black are more likely to provide material support to their networks versus people who are white are more likely to have wealthier networks. So they'll put those same dollars into stocks or mortgages that will help them accrue wealth. And so with giving credit, what we're doing is we're saying that everybody sort of demonstrates their credit worthiness in different ways. And so if I borrow from you, Jeff, and I pay you back, that is showing my credit worthiness, but that signal isn't going to mainstream commercialized finance. And so one of the ways that we're looking to sort of unearth that is to say, this idea of credit invisibility is invisible to who? Really, we're centering the mainstream commercial system when we think about credit invisibility, because while maybe I'm invisible to Experian, I'm not invisible to my neighbor or to my friends. And so how can we unearth that and then report that to credit bureaus to give everybody mainstream commercial recognition for the ways that they're paying back friends and family, the same as I'm recognized when I pay back my credit card?
Well, so I think it's obvious to people listening that you have a deep expertise and background in U.S. history and research. So take us a little bit through your unique background and what I'll call an unlikely evolution into a fintech founder.
Yeah, absolutely. I'm as surprised to be here as anybody else. So in my whole career, I have focused on domestic poverty and then kind of dovetailed into financial inclusion or exclusion, probably more accurately. And so those intersections with software engineering and data analytics. I have a master's in public policy from Carnegie Mellon. And so for a number of years, I worked at a national nonprofit organization that provided unconditional cash transfers to people living with low incomes. I was the chief technology officer there, and we built a platform that distributed over $200 million to hundreds of thousands of people living with low incomes all across the country. So I'm not coming at this from a finance guy standpoint. I'm coming at this from a nonprofit social impact standpoint. But in the process of providing cash transfers at scale, I saw how many cases people would take these dollars and lend them to others in their networks. And so seeing that professionally, then thinking about my own personal life, my mom, she's an immigrant from Panama. She borrowed from her network in order to afford the down payment on the home that she raised me and my brother in. My late wife was an immigrant from Mexico. Her mom has a small tamale business in Columbus, Ohio. She doesn't have any formal banking relationships, but she does have credit with me, with others. She both borrows and lends. And so I came to realize that this isn't just a me story, an immigrant story. It's really an everyone's story. In fact, 90% of low to moderate income individuals engage in peer lending. So I started thinking about my previous work in cash transfers really as capitalizing these informal social credit networks, and was fortunate to get the opportunity to join Princeton University as a practitioner in residence in the public policy school, where they gave me the time and space just to start exploring this area. And so the first thing I did was start interviewing people all across the country about their peer lending and really focusing on people living with low incomes. And I learned a lot in that process. First, I've yet to talk to anybody who charges their mom or their neighbor interest on these loans. Second, I found that the lending and borrowing tends to be bidirectional. So I thought that there would be one person being the lender, one the borrower. And what I found was that it really is sort of bidirectional, and that we're doing an income smoothing kind of across us based upon the timing and expenses of what's happening inside of our respective households. The third thing I found was I wrongly thought that people would get in trouble with the payday lender first and then reluctantly turn to their network to bail them out. I found it was the other way around, that really people were turning to their network first, but when they tapped out the network or they thought they tapped out the network, only then would they reluctantly go to the payday lender. And so all of that really was sort of the origin for creating Giving Credit, which is a web-based mobile fintech platform that recognizes and capitalizes peer lending that's happening in communities all across the country.
It's an amazing background, and I love the story and kind of where you've landed here and us getting to know you guys a little bit better. And with VantageScore, our aim is to always do things at the biggest scale possible. We're able to score almost every adult in America. But of course, that's not every adult. And I think I heard a stat in your answer there. I think it was 90% of, was it immigrant families engage in peer-to-peer lending? Did I have that right?
So it's much bigger than that, of all low to moderate income individuals. And so that's from a book called The U.S. Financial Diaries.
So huge opportunity there. What are the keys to unlocking the potential credit health benefits within that huge population, and to do it, at the scale that really you want to have?
Let me speak both from a giving credit standpoint, and then let me speak more broadly. So from a giving credit standpoint, one of the things we're working on is reporting these peer loans to credit bureaus. So we think that there's an opportunity there as giving credit grows and scales, if we are able to really scale capturing these what we call social credit networks across the country. We also think that even outside of reporting directly to credit bureaus, there's interesting signals in our data that could be used for alternative underwriting. But with giving credit, while yes, we are a tech platform and of course are looking to scale that, our focus isn't on giving credit necessarily being that one and only mechanism. The fact is that if you think about transactional records that any bank has, or PayPal or Venmo or any company like that, as you have all these transactional records, you could imagine mining that data to identify places where maybe I've given you a loan, Jeff, and then you've paid me back. And so if you can build a model that can sort of recognize those reciprocated transactions, you could then use that passively in the same way as companies like yours are working in cash flow underwriting to algorithmically identify the ways that people are repaying peer loans and help that also boost their credit scores.
Absolutely right. And I think that that's a huge opportunity for organizations like ours in the future. So looking maybe at just at the near future, the next 12 months, what are the key milestones you're hoping to accomplish?
Not only am I accidentally in finance, I'm also accidentally an entrepreneur with a startup. And so we're fortunate to both have support through Princeton University, where I've been incubating this idea now in my second fellowship there. And also we have seed capital from a group called Unorthodox Philanthropy, which allowed me to bring in a co-founder and former colleague, joined at the beginning of the year. So we have capital for this year. We have a couple of pilots in different parts of the country underway. We have a lot more pilots that we're scoping for next year. And what's exciting about that is it's not just sort of partnering with other nonprofits, but it's also credit unions, CDFIs, and even for-profit businesses, which has been a welcome surprise for us. And so we're looking at executing those pilots this year, raising funds towards the end of the year for 2025, when we'll be expanding our pilots and then growing our membership on giving credit.
That is awesome. Thank you, David. Where can people go to learn more?
Yeah, just come to givingcredit.org. Anybody can sign up. Or if you want to learn more about what we're doing, then just about.givingcredit.org, or you can link that just from the givingcredit.org website.
David, thanks for joining us. We appreciate everything you're doing, and we at VantageScore are certainly aligned in your mission.
Appreciate it. Thank you, Jeff.
Giving Credit estimates that U.S. households hold over $200 billion in peer-to-peer debt. There's that B word again. Of course, extending these loans is massively helpful to the recipients, but they're not getting credit for paying the loans back, and the lenders themselves risk their own personal financial well-being. But the good news is that where there's scale, where there's transactional history, where there's opportunity, fintech has proven it can step in and create markets out of what is seemingly massively unstructured. We'll check in with David's milestones for sure. I'm Jeff Richardson, and I look forward to our next conversation.
The views and opinions expressed in this episode do not necessarily reflect the official policy or position of VantageScore Solutions. Visit VantageScore.com to learn more.